Hi, I'm Gloria Ledoux here on the CU Compliance Connection by League Info site, bringing you the Compliance Outlook for a review of compliance effective dates for the fourth quarter of 2019 and first quarter of 2020. As you can see, the NCUA has been pretty busy reviewing their regulations as they promised and making them less prescriptive for credit unions. Specifically for the fourth quarter, we have some changes to the appraisal rules, Fidelity bond and insurance coverage, and finally another payday alternative loan option for credit unions to take advantage of. In the first quarter of 2020, we always have the annual updates to review with you guys. Keep in mind that when we film this video, we don't have all of the updates available yet, like the HMDA annual asset threshold or the asset thresholds for the small servicer exemptions under the mortgage rules. Those typically get published towards the very end of the year. We will, however, make sure to cover them in our next video to ensure credit unions are on top of the changes as they start the new year. We also have an update to provide for the use of the new Uniform Residential Loan application. For the NCUA, we also have a few additional changes that become effective in the first quarter, including changes to the Supervisory Committee audit requirements and guide, federal credit union bylaws, and the ability for credit unions to accept public unit and non-member shares up to certain limits. Also, NCUA has a change regarding their dollar limit for SameDay ACH transaction that becomes effective at the end of the first quarter. So we have a lot to cover. Let's get started. First, we just want to draw attention to the appraisal exemption that was part of S2155 for appraisals in rural areas. Although this became effective in May 2018 when the law was passed, the NCUA formalized the requirements within the regulation in this last update. So, if the credit union is making a real estate loan for less than $400,000 and they have contacted at least 3 state-certified or state-licensed appraisers from their approved list and have documented that no one was available within 5 business days beyond customary timeliness standards and beyond reasonable fee standards, an appraisal is not required. Credit unions should be reminded that this is not applicable for high-cost mortgages or if the NCUA believes an appraisal is necessary for safety and soundness concerns. Let's move along to the bulk of the appraisal changes the NCUA made, which became effective on October 22, 2019. For those credit unions doing commercial real estate transactions, the threshold exemption has increased from $250,000 to $1 million. Now, keep in mind, although credit unions can take advantage of this exemption, an appraisal may still be critical for the credit union to determine value and that they have proper collateral for their loan. Many CUSOs and industry experts have also cautioned credit unions. While the threshold has been increased, credit unions should still proceed with caution. The amendments also provided some clarity on written estimates, where applicable, in lieu of an appraisal, and the criteria for those individuals who perform the written estimate. Specifically, that they should be independent from loan production and collection processes, having no interest in the property or transaction, and obviously to be qualified to perform the type of estimates required. There's also some guidance for smaller credit unions where maybe independence is not able to be achieved. The rules specifically indicate that in these cases, the credit union must be able to demonstrate clearly that it has prudent safeguards to isolate its collateral value program from influence or interference from the loan production process and collection process. Here's an easy-to-review breakdown of the appraisal requirements. Starting all the way at the left, we clearly clarify what types of loans are required to have an appraisal with a state-certified appraiser. Specifically, as we discussed, the commercial real estate loans over that $1 million threshold. Also, for residential real estate transactions, if the transaction is complex, or $250,000 or more of the transaction value is not insured or guaranteed by a U.S. government agency or sponsored agency. In the middle column, there's some flexibility here for certain loans to be conducted by either a state licensed or state certified appraiser. For example, if the transaction is not complex. Last but not least, the requirements for all transactions at a minimum, unless otherwise exempt, should have a written estimate of market value. Okay, moving along to another NCUA rule that became effective on October 22nd, 2019. There are new requirements that will impact the credit union's board of directors. Specifically, at least annually, the board will need to review its Fidelity and other insurance coverage to make sure it is adequate in relation to the credit union's risk and requirements set by the NCUA. And the board must also review all applications for purchase or renewal of Fidelity bond coverage. The board then must pass a resolution approving the purchase or renewal of the coverage and must delegate one board member who's not an employee to sign the purchase or renewal agreement and all attachments. The credit union should keep in mind that they cannot have the same signatory on consecutive purchases or renewal agreements for the same bond coverage policy. There were also some changes within the rules that require certain coverage for involuntary and voluntary liquidations, so credit unions should be aware of that. Additionally, there are some options available for Fidelity bond coverage for a QSO, provided that the credit union owns more than 50% of the QSO. The QSO is composed specifically of the credit union's employees, and if the purpose of the QSO is to handle certain business transactions for the credit union. Last but not least, to conclude the changes for Fidelity bond and insurance coverage, the NCUA indicated that their bond approval forms will expire after 10 years unless otherwise determined by the NCUA. As they do now, the NCUA will have pre-approved bond forms on their website for credit unions to access and use. However, credit unions are reminded that any changes to those forms or anything that is added or amended to limit coverage will require additional NCUA approval. Some exciting news for credit unions who offer their members a payday loan alternative. They have another option to utilize effective on December 2nd. There are still the same APR limits, the 1,000 basis points over the maximum interest rate set by the NCUA, and a limit on the application fee of only $20. However, credit unions can now structure a payday alternative loan up to $2,000 with a maximum term of up to 12 months. There are still limitations on how many payday alternative loans a member can have in a rolling 6-month period. However, the NCUA did remove the rolling 6-month requirement for extensions of PAL terms, provided it's still within the maximum loan terms and does not include any additional fees or additional credit to the borrower. Additionally, with this new loan alternative, there's not a requirement for length of membership. Hopefully, credit unions are able to take advantage of some of these loan options for their members. Also, please note that the CFPB issued their payday alternative loan rules, which became effective in August this year. And there is an exemption from those requirements for credit unions if they are complying with the NCUA's payday alternative loan options. The CFPB's rules are very extensive, with certain payment and withdrawal restrictions, disclosures, registrations, etc. So credit unions offering payday alternative loan programs are encouraged to comply with the NCUA's rules, even if they are not federally chartered. All right, moving right along, let's talk about the changes that will become effective in the first quarter of next year. As always, it's very important for credit unions to be aware of these threshold changes that occur every year. They should not only ensure their policies and procedures are updated, but ensure their core systems are updated to also reflect these changes. First and foremost, the safe harbor penalty fee limits for credit cards have increased by $1, which are now $29 for the first late payment fee and $40 for each subsequent violation within the following 6 months. Credit unions should verify they are not charging more than these amounts. For a loan to be considered a qualified mortgage and receive the safe harbor protections, the loan's points and fees must not exceed certain thresholds. These thresholds typically increase each year. These are the new thresholds for 2020. If credit unions are relying on their lending systems to acknowledge if a loan is considered a higher cost, higher price, or in this case, a qualified mortgage under the rules, it is critical to ensure these thresholds are updated. The Home Ownership and Equity Protection Act, or HIPAA, governs high-cost mortgage requirements. If the credit union is originating a mortgage that is considered high cost, there are specific disclosure requirements, certain restriction on transaction terms, fees, and practices, specific ability to pay requirements, and home ownership counseling obligations. Therefore, it is critical for the credit union to identify if a mortgage loan will be considered high cost. Effective on January 1st, 2020, a loan will be considered high cost if its points and fees exceed 5% of the total loan amount for loans greater than or equal to $21,980, or 8% of the total loan amount, or $1,099, whichever is less, for a loan that is less than $21,980. There are certain appraisal requirements for loans that are considered higher priced, which we have listed on the slide. However, higher priced mortgage loans that are less than $27,200 for 2020 have an exemption from these requirements. In our last quarterly update, we talked about the changes made to the Uniform Residential Loan application and the option for credit unions to use this updated application effective on July 1st, 2019. We also talked about the requirement for those credit unions that sell their loans to Fannie or Freddie to use the revised URLA for new loan applications received on or after February 1st, 2020. Well, since we recorded that update, the Federal Housing Finance Agency, Fannie and Freddie, have announced that they are postponing the mandatory use of the revised URLA. There isn't a new date out there yet for credit unions to consider, but those of you that were scrambling to update your systems and forms can relax, for a few months anyway. Effective on January 2nd, 2020, federal credit unions will have access to updated bylaws. These updates include legal opinions that have been issued by NCUA's Office of General Counsel to provide credit unions with more flexibility and access them directly within the regulation. Specifically, the bylaws were updated to define a member in good standing, which does not include a member who is significantly delinquent, caused a financial loss to the credit union, or has engaged in violent, belligerent, disruptive, or abusive activities. The revised bylaws go on to provide examples of those types of behaviors and provides for the credit union's ability to limit services if there's a logical relationship between the objectionable activities and the services to be suspended. The new bylaws also provide options for offering different par values for classes of members, such as minors, students, or non-natural persons, provided the action doesn't violate any federal, state, or local anti-discrimination laws. While the NCUA didn't approve of a completely virtual annual meeting, they did provide for the ability for credit unions to have a hybrid in-person and virtual meeting. Also effective in the beginning of January are the changes made to the Supervisory Committee Guide, which is being replaced by an appendix within Part 715 of NCUA regulations. The NCUA has said that it will not completely remove the Supervisory Committee Guide, but there will be strong language to note that the guide is no longer compliant under the new rules. Part of the content changes include the addition to the minimum procedures for Supervisory Committee audits, which will require the review of board minutes, policies, and procedures, and also the testing for unrecorded liabilities. Also, there were a few outdated audit options that were eliminated in the final rule, including the report on examination of internal controls over call reporting, which was an option to a financial statement audit for credit unions with less than $500 million in assets, and the elimination of the balance sheet audit option, which was determined not to provide sufficient information to allow a board of directors enough information to assess the financial health of the credit union. Also eliminated was the 120-day report delivery deadline for the required terms for audit engagement letters with outside compensated persons. Now, there is a flexible standard that will require only that the target delivery date allows the federally insured credit union to meet its requirement to obtain an audit each calendar year. Moving right along, effective at the end of January is the NCUA's rule allowing federal credit unions to receive public unit and non-member shares up to the greater of 50% of the credit union's net amount of paid-in and unimpaired capital and surplus, less any public unit and non-member shares, or $3 million. This is an increase from the previous rule, which only allowed 20% of the credit union's total shares, or $3 million, whichever is greater. In addition, the NCUA amended Subpart B of Part 741 that applies to regulations codified elsewhere and applicable to federal credit unions that also apply to federally insured state chartered credit unions, thus allowing for all federally insured credit unions, state and federal chartered, to take advantage of this rule provided they have the authority to accept such accounts. Now, moving on to NCUA. Credit unions have been transitioning to the SameDay ACH requirements since September of 2016. With the three-phase process, it was easier for credit unions to slowly comply with the requirements. From the beginning, the limit for the SameDay ACH transactions has been $25,000. However, effective on March 20th, 2020, NCUA increases the SameDay ACH transaction dollar limit to $100,000. Credit unions should be aware of this change and make sure their disclosures and agreements are updated accordingly. Whew. With each update, it's obvious that credit unions are still dealing with a slew of new laws and regs to review and consider. Even though the recent regulations coming out of the NCUA are less prescriptive, it still takes time for credit unions to review and implement any necessary changes within their policies and procedures. Just a reminder that League InfoSite, along with your league or association, is working together to help get you helpful resources at your fingertips to save you time. These compliance support tools are typically provided for free or at a very low cost through your league or association and can be crucial in helping you to manage compliance. InfoSite provides an overview of compliance requirements for applicable laws and regulations, both state and federal. The system also tries to aggregate helpful resources on topics so that you don't have to spend the time researching. Check it out. We are confident it will make your life a little easier. As an additional reminder, CU Policy Pro is our policy management system that provides over 240 model policies for credit unions to customize. You shouldn't need to create any policy from scratch. We are staying on top of these regulations and updating our model policies and content within the InfoSite platform to help you. If you aren't already familiar with these products, please reach out to us or your league or association to learn more. As always, thank you so much for joining us at the CU Compliance Connection by League InfoSite.